Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today in episode 315, we're going to talk about investment fees and specifically whether they really matter. Should we be thinking about fees or should we really be thinking about returns after fees? So in other words, if an investment has what we might think of as incredibly high fees, who cares so long as the returns that the investment gets us, even after fees, are really good, maybe even better than the S&P 500 or some other index. Isn't that really what we should concern ourselves with? That's the question we're going to cover today. Before we get to it, I do have one news item. There has been going through Congress, both in the Senate and the House, and recently it passed in the House, a bill to make some changes to retirement accounts. I don't think they're major changes, but they're changes. And I thought I'd just mention it to you in case you're not aware of this. And the one that went through the House, it's called the Secure Act. And I don't know what that's short for. I did at one point, but I forget. Anyway, it's called the Secure Act. And it's proposing a number of changes. Some of the changes in the Senate's version of the bill are different. So who knows how it will come out. We'll find out in time. But I think will at least give you an idea of the direction it's headed. And Forbes recently, a contributor on Forbes wrote about it and sort of picked out what they thought were the more significant changes. And so I thought I'd run through them real quick before we get to the main question of the day. The first one is that there's going to be some changes that you and I won't see, but we'll feel them. And that is they're going to allow small companies to sort of pull together and make 401ks, in theory, a little more affordable. The idea is that to get small employers, encourage them to offer 401k. So if you're working for a small company that doesn't offer a retirement plan, maybe with the passage of this bill, if it does get signed into law, maybe a better chance that your employer will offer a 401k or similar retirement plan. That's the first thing. The second one, this one sort of drives me crazy. They're increasing annuity options inside of retirement accounts. They're changing some what are called safe harbor rules that will encourage or at least maybe remove some obstacles to putting annuities inside a 401k. To me, that's a prime example of the insurance lobbyists doing their job. I don't know why in the world anyone would think that's a good idea, but there you go. This will affect some of you, increasing the required minimum distribution age. Right now it's 70 and a half. You got to love the half. Anyway, increasing it to 72. So I guess not maybe a major difference, but it's change. So that's the third thing. They're talking about removing the age limitation on IRA contributions. Again, probably not going to affect most of us, but if some of you wanted to continue to contribute to an IRA later in life, they're talking about removing age limitations. They're talking about, this is interesting, a penalty-free distribution for when you have a child or when you adopt a child. And I think it's up to $5,000 you can take out penalty-free. You'd still pay the taxes, assuming it's a tax-deferred account. So you can't avoid the taxes, but you would avoid the 10% penalty. I understand sort of the policy behind that. And I'm not saying it's a bad idea, but I don't know, anything that encourages folks to take money out of the retirement account, I kind of cringe at a bit. But not a bad thing, I guess. I know we could have used it when we adopted our two children. Adoption is expensive. Anyway, those were the main changes from my perspective. There are other things, for example, if you inherit an IRA, they could change the rules on how you can take that money out. Right now, and this doesn't apply to a spouse because a spouse can basically take the money into his or her own IRA. But if you inherit an IRA from someone other than your spouse, then you either take it out over a 5-year period or you can basically stretch it out over your lifetime and take required minimum distributions over your lifetime, which is what I do for a small IRA that my stepmother left me when she passed away in 2012. They're talking about changing that so that you would effectively, the current version of the bill, you would have to take it out over 10 years. Why do they care? It forces you to pay the taxes sooner. That's That's the issue from the folks inside the Beltway, as they say here in Washington, D.C. So some changes to retirement accounts. I wouldn't call them huge, but they might affect you. And once the bill becomes law, if it does, I'll mention it again in an upcoming podcast, let you know what actually ended up becoming law. We don't know that yet, but it sounds like this has a pretty good chance of becoming law, even in our current political environment. This one looks like one that's making its way through the system, so we'll just have to see what happens over time. All right, so today's topic, fees. I talk a lot about fees. And in the Facebook group, a fellow named Mark asked what I think is a great question. I mean, it really is. And it's this. He says, the whole discussion on fees seems a bit obsessive to me. Just curious, but how come there is never a piece of the discussion on the returns as part of the entire equation? Is it automatic and guaranteed that index funds will beat every managed account every time? Maybe paying a fee to an advisor for certain investors nets the most for that investor, including the fee. Thoughts? Well, great question, and it's actually a couple of questions, right? I mean, there's the should we really be focused on fees, or and Mark didn't put it this way, but this is how I take it. Should we really be focused on returns after fees? And then this question of, do index funds really beat every managed fund every time? Those are two different but related questions, and I thought it was worth spending a few minutes today talking about it. So the first thing, I've got a number of things I want to go through, but to start with, let me change the question just a little. I agree completely with Mark that at the end of the day, what we're after is after fee returns. But I would add we want to also look at after tax returns. So it's not just after fee. We want to focus in on taxes. Now, if you're in a 401k and IRA, you're not concerned about the taxes, at least while you're accumulating. You worry about taxes once you start to take the money out, unless it's a Roth. But your mutual fund, let's say a mutual fund that you own inside a 401k, would generate a ton of taxes for you if you owned it outside the 401k. Well, you don't care, right? It's in a 401k. You're not paying taxes on it a year in and year out. But if you're investing it all outside of a retirement account, outside of a tax-advantaged account, then it's not just after fee returns you want to worry about. It's after taxes as well. And here's why that comes into play in the discussion between index funds and actively managed funds. It's this. From a tax perspective, index funds are incredibly tax efficient. Now, could we hunt down an index fund that's not? Probably, maybe, I don't know. But certainly all of the ones I've invested in that I've looked at, whether it's Fidelity, Vanguard, they're incredibly tax efficient. On the other hand, an actively managed fund may or may not be tax efficient, because remember, an index fund, they buy the stocks or the bonds that cover the index, and then that's it. Their job is done. Yes, there's some trading going on as they have to keep mirroring the index, and of course there could be some trading when investors want their money out, right? Particularly if we hit a bear market and people get scared and pull all their money out of a stock fund. But they're not buying and selling because of a new idea. Oh, wait, I don't like this company that we had. We're going to sell it and we're going to buy this company. In an actively managed fund, that's exactly what happens. That's their job, right, is to figure out what are the best investments. And depending on the fund, depending on the manager, depending on their philosophy, there can be a lot of buying and selling, which can trigger a lot of taxes. Now, there are things they can do to try to minimize that, right? They, just like individual investors, they can try to sell maybe an investment that the fund holds at a loss to offset some gains. And so, it's not completely out of their control. But a lot of actively managed funds generate a lot of tax liability. And so if you're investing in a taxable account, it's really important. You want to understand before you invest what the tax implications are for a given investment. And by the way, Morningstar has a section where you can go. In fact, since some of you are watching this on YouTube, I will quickly go to Morningstar and see. Hopefully I can find this quickly. We're going to be talking about American funds. So let me grab a ticker from American funds. I'm looking for those of you listening and not watching, RGAGX, which is the American funds, the Growth Fund of America Class R6. No idea what R6 means, but I'm sure it's really important. So if we look up this investment in Morningstar, you will see it comes up in the navigation. It comes up to a quote, and there's different tabs you can go to, including looking at the fund's performance, its portfolio, its management. But they have a tax tab as well, or navigation. And if you go to that tax tab, it will give you some tax information that's very helpful. And in this case, one of the things it does is it shows you the pre-tax return of the fund, and then it shows you the tax-adjusted return. Now, let's think about that. Morningstar doesn't know what your tax rate is, doesn't know where you live, what state. You could live in Tennessee. I don't know how Tennessee taxes capital gains. But in any event, you could live in a low tax state. You could live in a high tax state. They don't know my taxes. So they make some assumptions. So you have to keep that in mind. And you can obviously see that on the site. But within those assumptions, they show you the pre-tax return of the fund. So they obviously have that data. And then they show you what they call a tax-adjusted return. And so if you look at this fund, the longest time period is about 5 years. I'm not sure why that is. It must be, maybe that's when Morningstar started calculating this data, because the fund is certainly older than that. But if you look at since inception, which again, this is really over a 5-year period, you lose about 2 percentage points because of taxes. So at the 5-year mark, the pre-tax return over a 5-year period was just under 13%, but the tax-adjusted return, 10.63%. I should add, and I will come to this again, Morningstar returns do not include any load fees that you pay. So if you're buying a Class A share, for example, and you're paying 5.75% load when you buy it, that does not get reflected in the returns that you see in Morningstar. Very important to keep in mind. That being said, in this example, you're losing about 2.25% roughly because of taxes. So something to keep in mind. Now, of course, when you sell a fund, that's going to generate taxes as well, and that's certainly true for both index funds and actively managed funds. It's not really the question Mark had. I'm going to go back to the fee question for the rest of the show. But I wanted to, taxes are critical. If you're investing in a taxable account, you need to understand the tax implications of whatever investment you're making. All right, so back to Mark's question, and where do we go from here? He's certainly right? If you have an investment that has high fees, but the returns are just phenomenal, who cares, right? Let's say you're gonna beat the relevant index. Maybe you beat it handily, and who cares if you're paying 1%, 2%? Heck, charge me 30% if you want. If the returns are going to clobber the market, what do I care about fees? So the problem we get into is actually implementing that in a meaningful way. How would we go about picking, let's say, a fund or investment that has high fees, but that we think will, even with the fees, return more than an index? How do we find that kind of fund, right? So what most people do that sort of go down this path, say, look at past results, right? What else do we have really, right? So let's talk about that. You've always heard past results are the past results are no indication of the future. Just because something did well in the past doesn't mean it'll do well going forward. But on the other hand, that's really all we have to go on, right? When we think about the difference between stocks and bonds, and that stocks outperform bonds, well, that's been true in the long term in the past, but I don't know, maybe it won't be true going forward. Aren't we all sort of prisoner to past results? Well, to some extent, yes, but exactly what we do with those past results, that's where I think investors can differ. So let's take an extreme. We could say, well, wait a minute, you're right, past results are all we have. So let's just pick the single investment that over the last, pick your time frame, 20 years, 40 years, it needs to be long. We're not going to do the last day, the last year, but whatever, the last 40 years, 20 years, and we'll just put all our money in that. It's probably an individual stock, right? And maybe it's a commodity, probably not. So maybe it's a stock, and we'll just throw all our money in that. Why not? If we're going to look at past results, why bother with a mutual fund? If there's some investment that even clobbers the best mutual funds out there, let's just put all our money in that one fund. By the way, at various times, that would have been Philip Morris. I know they're not called Philip Morris anymore. At one point, over a pretty long period of time, the returns were phenomenal because the stock price was beaten down because of all the lawsuits, And then when you did the stock buybacks and the reinvestment of dividends at those lower prices, while at the same time you had a company that was a cash cow, returns were pretty impressive. I don't know if it had been number one, but it'd have been up there. So we could just do that. Now, the first reaction, come on, Rob. Now, yeah, you're being silly, though. You're taking this to a ridiculous extreme. I mean, yes, past results, we have to look at them, but no one's really suggesting that. Well, that's true. They're probably not. But it's actually not as crazy as it sounds, right? Warren Buffett, he has the vast majority of his wealth in one company. True, he owns other things, but you're talking tens and tens and tens and tens of billions of dollars in a single stock. Maybe more down to earth. That's Warren Buffett. He sneezes and $100 million comes out, so I get it. But how about family businesses? There are plenty of families out there, very wealthy, and just other families, just hardworking folks that might not be called wealthy, but the vast majority of their wealth is in their own business, right? I know folks like that. I've got good friends that own, my sister, painting company. That's where her investment is. I've got a cousin who owns a tire store. That's where his investment is. It's not at all uncommon for folks to have the majority of their net worth in a single company. Now, it's not a publicly traded company. I got you there. Private company, but maybe not as uncommon as you might at first have thought. But okay, fine. Putting all our money in a single stock, admittedly extreme. So let's back it off a little bit. Let's just pick an asset class, right? Why pick a single mutual fund, active or otherwise? Let's just look at the last 30 or 40 years, 20 years, again, whatever long time period you want to pick, and put our money in an asset class that's done the best, right? Well, if we did that, and the data's out there. For those on YouTube, I'm going to open up a giant spreadsheet. Well, it's actually not a spreadsheet. It looks like a spreadsheet. This comes from Portfolio Visualizer. And this doesn't go back too far. It goes back to 1989. So that's still 30 years. And it shows the annual returns of all kinds of asset classes, from U.S. stock market, large cap value, large cap growth. There's bonds in here. There's tips. And they don't actually calculate the compound annual growth rate, which would actually be nice. But in kind of just eyeballing this thing, the one that sort of stood out to me was emerging markets. Now, the data doesn't go back quite as far. It goes back to 1995. And there's some big negative years. But man, there's some huge positive years. I mean, in 2003, a funny story. So in 2003, emerging markets returned 57%. It was that year that for the first time I invested in the Vanguard Emerging Markets Index Fund. Here's the funny thing. I had no idea what I was doing. If you'd have asked me, what's an emerging market? I didn't know. I just thought it was a foreign fund. I didn't know that it was risky. And I happened to invest in 2003. It returns 57% that year, 26% the following, 32% the year after that, 29% in 2006, and almost 39% the year after that. Talk about a nice 5-year run. Of course, it lost 52% after that, and then gained 75, then 18, then lost 18, then gained 18. You get the idea. Emerging markets is a bit of a roller coaster. But that could probably, be the asset class that's returned the most over the last, 20, 25 years. Let's just put our money in emerging markets. Yeah, we'll have some bad years. But if we're going to go on past data, why not? So why don't we do that? I know of no one that suggests that. And the answer is yes, we look at past data, but we also recognize that we have no idea what the future is going to hold, right? Some might say it won't repeat itself, but it might rhyme, maybe. But we just don't know what emerging markets are going to do. And this is maybe even more important for you and me, we don't know what it's going to do over our specific investing horizon. So if you're 10 years from retirement, your picture looks very different than someone who's 20 years from retirement. And, we might look at a 50-year period and get some comfort. But again, it would still depend on exactly which 50 years you picked. And we don't know what's going to happen. And does anyone really want to risk their retirement, their life savings, making that bet on not just on emerging markets, but on emerging markets during your specific time period when it matters most to you? Of course not. We don't, right? As soon as we move away from a single investment, we're doing so because we're ignorant, because we don't know, we have a lack of knowledge. We can't predict the future, right? If we could predict the future, we would just go pick the single investment. We'd be happy investing in Amazon if we knew that over our time period that matters to us, it was going to be the number one investment. Of course we would. Why wouldn't we? But we don't know. And even when we get to an entire asset class like emerging markets, we just don't know. And then one could even say that about the United States, right? While it's done incredibly well since after World War II, is it going to do as well in the next 50, 60, 70, 80 years? Well, who knows? We've got a lot more competition internationally. We could think of a lot of reasons why it might not. The national debt, the political turmoil, the competition from other countries, climate change. We could think of a lot of scary things that could lead us to believe that maybe the future will be very different than the past. But that's really, in a nutshell, the point. We don't know what the future is going to hold. And so because we're ignorant, that's what it is. Because we don't know stuff, we diversify, right? And then the question becomes, well, how much do we diversify? And that's when we kind of leave science to some extent, and I think come to more of art kind of enters the picture. Now, what some do is they say, no, we can figure that out too, because we'll get a lot of different asset classes. We're not going to just stick with emerging markets. We'll have U.S., we'll have small, large, some value, we'll have international, we'll have some bonds. But what we'll do is we'll look at all those asset classes, and we'll frankly do the same thing I just ran through. We'll see which sort of recipe of asset classes over a long period of time did the best looking backward, right? And then we'll just go forward. So value's always done pretty well. Small cap has done well. Emerging markets have done well. So we'll add all of those into the mix in a certain proportion. We'll back test it over some period of time, and we'll get the mix just right. And that's what we'll do, because in the past, that's what turned out to be the best. Now, is that a bad way to go? I don't think so. Why? Because you're incredibly diversified. You're not putting all your money in a single stock. You're not putting all of your money in a single asset class. You are very well diversified between large companies and small, value and growth, U.S. and non-U.S., stocks and bonds, right? Maybe some real estate, maybe some commodities if you want. And so, you may not repeat the past. In fact, you probably won't. And indeed, I would argue the odds of that mix being the number one mix for the next X number of years, just because it was the number one mix for the past number of years, probably pretty slim. But it's unlikely that it's going to cause you not to meet your retirement goals, your investment goals, right? Or at least as compared to other options. And so it's not a bad approach. But I also look at it and say there's absolutely no guarantee that it's going to be the best approach. And in fact, Warren Buffett has said for his wife, when he dies, he just wants 90% in an S&P 500 index fund and 10% in a bond fund. Now, I suppose we could dismiss that a bit because I'm assuming he's going to leave a lot of money to his family. So you could say, yeah, when you've got hundreds of millions or billions to invest, yeah, you can afford a bad year or two in the market. But I kind of suspect he actually thinks if he were going to if he were going to be an index fund investor, regardless of how much money he had, that's probably what he would do. So I spent a fair amount of time talking about past results, and you're going to see why, because it's going to come up again. But it's important that we don't get too enamored with past results. We look at them, we're certainly going to base some decisions on them to a degree, but don't fall in love with past results. All right. Now, we've talked about after fee and after tax returns. I want to kind of move into the second part of his question, and that is, do index funds always beat actively managed funds? And what does that even mean, really? And how do we even compare them? So the first thing you have to do is pick the right index, right? There are many indexes, right? There's the S&P 500, but then there's the total market index. There's small cap indexes. There's value versus growth indexes. There's international indexes. And picking the right index to compare an actively managed fund to is no easy feat. And I want to give you an example. And again, for those watching on YouTube, you'll see it. For those listening, I'll walk you through it. One of the funds that folks always point to in this debate, the debate being active funds versus index funds, is America funds. And the reason they point to them is because they've done extremely well over many decades. And I'm looking at one. It's the Growth Fund of America. We talked about it briefly when we looked at the tax issue, RGAGX. And on their website, they show a chart comparing the performance of RGAGX to the S&P 500 Composite Index from 1999 through the end of last year, the end of 2018. And if you invested $10,000 at the beginning of that time period, and you fast forward, an S&P 500, you would have ended up with about 30 grand. With RGAGX, almost, in fact, just a little bit more than 50 grand. It's a huge difference. Now, when you look at that, it's like, well, why wouldn't you put at least some money in RGAGX? Yes, we understand the caveats about past returns, but isn't that a risk worth taking? Well, maybe, maybe not. But here's the question. Should you compare the RGAGX to the S&P 500? Is that the right index to compare it to? So I didn't know the answer to that. How would you even find that out? How would you figure that out for yourself? Well, the first thing I did was I looked up RGAGX in Morningstar. And in Morningstar, I go to the portfolio tab once I get to that particular fund. And I see that it is a large cap fund. Most of, not all, but most of the investments are in U.S. large company stocks. So I see it's got 81%, 82% in U.S. stocks, about 11% in non-U.S. stocks, and then it holds about 6% in cash. Let me actually say one thing about cash. I've been critical of actively managed funds because, among other reasons, they tend to hold a lot in cash. And in fact, Jack Bogle talked about this in his book, how holding cash is a real drag on returns. Well, it's a drag on returns when the market's going up. You love it when the market's going down. Over the long term, it tends to be a drag. One thing, though, to keep in mind is a fund can use options and leverage to actually give you 100% exposure, even while holding cash. Whether this fund does that or not, I have no idea. So there's sort of a lot of pieces to consider. In any event, this fund holds almost 6% in cash. When you look at what's called the style box, which is basically a tic-tac-toe board, when we're dealing with equities, they'll put a dot where the average holding of this fund would sit in that tic-tac-toe board. The higher up the board, the larger the market cap of its average companies. And in this case, the further to the right means it invests more in growth companies versus value. Think value companies as companies that are undervalued. Ford is probably a value company. A growth company is one that is very, very likely overvalued, at least by typical metrics, but it's growing its revenue and it's growing its profit, hopefully, at a good rate. So you would think of an Amazon maybe as a growth company. In this case, American funds, the Growth Fund of America, just like the name suggests, is invested heavily in growth. I mean, it's the point on this style box is the tippy top right. I mean, it's almost outside the box. That's how growth oriented this fund is. Well, an S&P 500 doesn't look like that. If you go to an S&P 500, and I'm using the Vanguard Admiral Shares Fund, VFIAX, as I think a reasonable representation of the S&P 500, and you look at the style box, yes, it's large cap, but it's in the blend. It's sort of weighted a bit towards growth. That makes sense given the current market, but it's still within that middle row, middle column of the style box. So this is a blend fund, not a growth fund. So there's really we have no business comparing RGAGX to an S&P 500. So what could we do instead? Well, what I decided to look at was the Vanguard U.S. Growth Fund Admiral Shares. Let's look at an index fund that's a growth fund to compare it to. So I grab the ticker VWUAX, and I go back to Morningstar, and we can compare these two funds pretty easily. What we do is we go to the Performance tab for the American Funds Mutual Fund. I'm going to do an expanded view. and then I'm going to hit the compare button. And I can just drop in the ticker for the Vanguard fund and add it. Now, in the expanded view, it only goes back to 2009. That's the data that I've got. And that presents another issue that you need to think about when you're comparing an actively managed fund to an index fund. And by the way, if at this point you're thinking, Rob, this is far more complicated and nuanced than I would have ever imagined, yeah, it sure is. Here's the issue. You really want to compare investments over at least a full market cycle. So you don't want to just capture, say, a bear market. You also want to capture a bull market. And in this case, we're not really capturing a bear market. I mean, in 2009, let's see, the market hit bottom, I want to say in March, but then it recovered. And we've basically, been in a bear market ever since. Yeah, we had the dip at the end of last year. So in some ways, this is not an altogether fair comparison, but this is the data that I have. But it's something to keep in mind. Now, when we look at this data, so now we're comparing the Growth Fund of America to a growth fund, right? And it shows a different picture. In 2009, the Vanguard fund beat the American funds by about a point, actually about half a point. Then it lost to it in 2010, beat it by about 4 percentage points in 11, lost to it by 2 or 3 in 12, beat it by just a little bit, maybe 1 or so, 1.5 in 13, beat it by about 4 in 14, 3 in 15, lost to it big in 16 by like 8 or 9%, but then in 17 recovered and beat it by 5%, beat it by a couple of percent in 18, and so far this year in 2019 it's up over the American funds fund by 3% or so. You see a different picture. And so that's really important to understand. You've got to compare an actively managed fund to the right index. And when you do, you'll see a different result. Not every fund should be compared to the S&P 500 index fund. And what I just walked through is how I would do it. Again, this goes back to 2009. Now, this leads to an interesting question. I mentioned that you really want to compare them through a full cycle, and this doesn't do that. I could have tried to look up the data going back further, but I don't think it's necessary for our show. Obviously, when you want to dig into a specific fund, I highly recommend you do that. But here's a question to ask, and it gets into behavioral finance. Let's say you invested in RGAGX, and you compared it to a growth kind of fund like this Vanguard fund, and but you've decided because of past results that you're going to stick with RGAGX. Here's the question. Would you be able to stick to it through these last 10 years? When you see that, yeah, it beat the Vanguard fund some, but overall it didn't. Now what are you going to do? How are you going to feel about that? Are you going to stick to it, right? Because when you look at funds, actively managed funds that have beat an index over a long period of time, you have to have the ability to suffer through bad years compared to that index. And I'm not sure everyone can do that. See, when an index fund goes down, it's not because of the fund manager, right? They didn't make a bad investing decision. It's because the market's down, which is usually because of a recession. There can be other reasons too, but it's not the fund. When an actively managed fund is down, particularly when it's not just in the negative, but it's underperforming its relevant index, now you have to ask some tough questions. Did the managers, did they make a mistake? Have they lost their touch? Maybe there's a new manager that's come in. Maybe they've changed their investing approach. How are we going to catch back up? And, if you can stick through those kinds of questions and stick with your investment plan, I think there are actively managed funds out there that are pretty good. And you'll probably do just fine. I think American funds are an example of that. I think Dodge & Cox is another example of that. These are funds that by and large charge, as for actively managed funds, lower fees. Think 60, 70 basis points, which is low for an actively managed fund. I would avoid the load charges. There's no reason to pay 5 3/4% after every dollar you invest. If you want investment advice, you can get it a lot cheaper than that. But in terms of the ongoing expense ratios, 60 to 70 basis points for an actively managed fund, relatively inexpensive. Could you do okay with these funds? I think probably. Will you beat the market? I think it's unlikely, but you never know. Maybe you will. Is that a chance you want to take? And will you be able to live through what could be years where your funds are significantly underperforming the index? That's the question that you have to answer, right? Okay. Now, when we're comparing actively managed funds to index funds, one of the things we have to keep in mind is that We're not ever saying that an index fund beats all actively managed funds. That's never happened, right? At least not over short periods of time. And I don't know that if you went long enough, well, if you go long enough, there's no actively managed funds. I mean, you could recreate the index back quite a long time, and actively managed funds didn't even exist. But even if you keep it reasonable, you're likely to find actively managed funds that can beat the index for long periods of time. That's not what people mean. When you read that index funds beat actively managed funds or actively managed funds beat index funds, here's what they're doing. They're looking, first of all, they have to pick a time period, right? We have to assess a time period. And as an example, I'm going to come back to this article, but this was an article from a company called Asset Builder, which is an investment advisor that invests in index funds. So that's their perspective. And they were looking at how the American funds, and 5 in particular, have performed against the index over a 15-year period. And for those watching on YouTube, you can see some of the results. I'll talk about them in just a second. You have to pick a time period. Are you looking at the last 15 years, the last 20 years? But that's the first thing. You have to pick a time period. Then you have to account for those funds that maybe existed when that time period began, but then closed, right? You can't exclude those. Otherwise, you get what's called survivorship bias. You're just looking at the ones that lasted long enough to get to the 15 or 20-year mark. You've got to consider all of the funds that existed 20 years ago, and you have to exclude all of the funds that didn't exist 20 years ago, but came into being sometime during that 20-year period. Again, if we're using 20 years as our benchmark. So that's a lot of work, something that frankly, most of us, we'd be hard pressed to get that data, right? We'd be hard pressed to get that data. But when you're reading other studies, that's what you need to be looking at. Is there survivorship bias involved? Are they looking at all of the funds that existed during the beginning of the time period? And why are they looking at the time period that they've chosen? If they cherry picked the time period, right? If it's the last 20 years, well, what's it look like if it was the last 18 or the last 22? Do the results change, right? That's particularly true when you're reading studies that are written by folks that have skin in the game, like Asset Builder. In this case, this could be a perfectly great study, but they obviously have a vested interest in index fund investing. If you're looking at a study produced by growth funds or American funds, well, they have obviously a vested interest in their actively managed funds. And in fact, they have a video that shows their funds compared to the S&P 500 going back, I think, to the 70s. And so you want to be aware of these potential biases that can impact the results. So once you figure out the time period, you account for survivorship bias, and you make sure you're sort of comparing apples to apples. What they then look at is what percentage of actively managed funds beat the index. And if it's less than 50%, they conclude the index is won. The index funds won. And if actively managed funds more than 50% beat the index, then actively managed funds win. So to Mark's question, it's never the case that every actively managed fund underperforms the market every time. No, that's just not true, right? And there are going to be plenty of funds, particularly as we get to shorter time periods, that absolutely do beat the index, right? Now, one last thing when we're comparing, and then we're going to get to what this all means. Some funds and groups of funds, and by funds I mean actively managed funds, tend to have a better chance of beating the index if you're in the right asset class. It's very hard for U.S. large cap blend actively managed funds to beat the index. But it's much easier if you're talking about a mid-cap or small-cap fund, or if you're talking about emerging markets, or even certain bond funds, right? And so when you start to look at this from an index-by-index basis, you'll see the results vary. In fact, in one study I looked at, mid-cap funds actually had a higher chance of beating the index. I don't know why mid-cap than other asset classes did. So not every asset class, when it comes to beating the index, is the same. So, okay, yeah, I know what you're thinking, Rob. I'm exhausted at this point. I get it. You got to look at not just fees but taxes. In comparing actively managed funds to index funds, you got to pick the right time period. You got to account for survivorship bias. You got to pick the right index to compare them to, and the results will vary depending on the type, the asset class, and which index you're comparing it to. Got it. So what does this all mean? What's the summary of all of this? Well, it's this: that over time, particularly for what I think is the core of most folks' portfolios, index funds do outperform more than 50% of actively managed funds. Do they outperform all actively managed funds on an after-fee basis? No. If you go into after-tax basis, they do outperform more. Gets even better for index funds if you're in a taxable account. But are there going to be actively managed funds that you can find that have beat the index, whichever index you want to pick, over long periods of time? Yes, they will exist. So now what do we do? Well, my take has been the following. If I think ahead, next 20 years, let's say, I have no doubt that there will be actively managed funds that will beat the index in each of the relevant asset classes for my investment portfolio. Here's the catch. One, I don't know which ones they'll be. Can I go back in time and find the ones that did beat it? Sure. And I guess I could pick on that basis, and I might pick American funds if I were going to do that, although we're going to talk more about American funds in a minute. I could, but I have no idea if they're going to beat the indexes over the next 20 years. More importantly, or as importantly, I don't know if I'll be able to stomach the underperformance that they will likely, that I would likely encounter, even if 20 years from now they ended up winning the race. I'm going to have to live through periods of time when they've fallen behind. And I'm not so sure I'm so good at doing that. I'm not sure I'm going to have the confidence, because remember, in this little conversation we're having, we're assuming they're going to beat the indexes 20 years later. But when you're living it and you're watching your portfolio underperform, you have no idea if they're going to end up catching up to the index and outperforming. So when you add all of that up, I still think, in fact, very strongly, that for most investors, most of your portfolio should be in index funds. Now, in this debate, American funds tends to be the one fund family that comes up the most when one's arguing in favor of actively managed funds. And I want to show you why. I want to go back to this Asset Builder article. And if you're listening to this on the podcast, I highly recommend that you watch the video, because the images here are pretty compelling. But if you want to Google it, just the title of the article is "Investing with American Funds is like betting on Tiger Woods." So if you just Google that, you'll see the article. But in it, they have an image that actually comes from, I'm pretty sure, comes from American funds, and it shows the return of the funds from 1976 to 2016. And it compares it to the Vanguard 500 Index Fund, and it compares 5 American funds. Now, and it assumes you started with 10 grand. So in 1976, let's see here, I think Carter was president, to put this in context. So Carter's president, you got 10 grand, which is a lot of money today. It was a heck of a lot of money then, and you invest it. Fast forward to 2016, in a Vanguard 500 Index Fund, you've got 641,000. That underperforms all 5 of the American funds, U.S. American funds, that they've got in this comparison. The lowest American fund returned 812,000. Again, that's compared to 641,000 for Vanguard 500 Index Fund. The top fund, Growth Fund of America, just under 1.8 million. Now remember, we already looked at comparing a growth fund to an index, a S&P 500 index fund. That's a silly comparison. There's no basis to compare a growth fund to a blend fund. You wouldn't do that. So in some sense, you could criticize these results on that basis, but still pretty compelling. So how do we deal with that? Well, there's a couple of problems with this comparison. And one is, you could say, well, maybe they cherry pick the time period. If you didn't start in 76, but you started later, how would they do? That's a question, right? But I think there's a couple of things that are even more fundamental. The first thing is, when a fund starts out, it can have outsized years early on where it really is crushing its relevant index. And because of that, when you then stretch it out over long periods of time, the gap widens in the return results, even if that fund, after those first however many outsized years, doesn't do as well. Maybe it had some great years early on, which I think certainly happened with some of these funds. And then over time, it just started kind of hovering somewhere around the index. But because it had those early outsized years, the numbers look great 40 years later, right? But that isn't going to help you and I, because here's what happens. A fund does extremely well. What happens? Well, people hear about it. It's in Kiplinger. It's in Money Magazine. I think they're shutting down Money Magazine, by the way. In any event, and so what happens? People rush in. So then what happens? Well, now the manager has a lot more assets to manage. And as the assets grow, it becomes increasingly more difficult to outperform the index. And that's nothing specific to this fund. I mean, Warren Buffett has said, look, I'm managing hundreds of billions of dollars at Berkshire. My ability now to beat the index is significantly hampered because I got to find huge investments. Otherwise, I might find a great $10 million investment, but who cares? It's not going to move the needle, even if I quadruple the money in an afternoon. It's not going to move the needle on a Berkshire Hathaway size company, and it's not going to move the needle on an actively managed fund that's got billions under management. And so you've got to account for those early successes that can then make future years and the fund as a whole look better than it really is. Here's the second thing, I think even more important. They're assuming a lump sum investment of $10,000. Who invests like that? I mean, yes, there could be times in our lives when we have a lump sum to invest, but most of us, we're dollar cost averaging. Not even because we necessarily want to, it's just how life works. You make contributions in your 401k every month or your IRA. It's a month-to-month thing. So why didn't they show it this way? Why didn't they say, well, let's assume you invest $100 a month or $200 a month, or pick your number, and let's look at the numbers that way, since that's how most people invest. They didn't do that. Well, Asset Builder did. And they didn't go back to 1976. They went back 15 years. But that's great, because that does capture both a bull and a bear market. That captures the full cycle. And what they found was, if you assume, I think they assumed $500 a month, the amount doesn't matter, you see a very different picture. Now, by the way, the American funds did very well, but you don't see this picture where they're doubling and quadrupling or tripling the Vanguard 500 index fund. Instead, what you see is most of the funds underperform the comparison fund, and what Asset Builder used was the Vanguard Total Stock Market Index Fund. Most of them actually underperformed that fund. The one that actually outperformed it over 15 years was the American Funds Growth Fund. It outperformed it by about 35 basis points, but that doesn't include the load fees. Now, you might be able to buy that fund without a load fee, but if you're buying that fund with the load fee, you're going to have underperformed. And I would argue, as I mentioned before, you really should compare a growth fund to the American Funds Growth Fund of America, and I think the results would have favored the index even more, although I admit I only went back 10 years to do that. I didn't track down the data for 15 years, so the results could have been a little different. Here's the point. My point isn't to say that American funds are a bad investment. I think earlier alluded to the fact that if you invest in American funds and you stick to it, in good times and bad, I suspect you'll do just fine if that's what you want to do. But you certainly can't use American funds to make the argument that if you invest in them now, you're going to outperform the index going forward. You have no idea. No one has any idea, if you will. If you want to make that bet based on past data, you can. I don't think you'll ruin your retirement. I think these are solid funds, so I think you'll be fine. But in my case, I much prefer the index fund because I don't have a high confidence that they'll outperform going forward. And I don't have to worry about those years when they underperform the index and I have to start asking difficult questions about the fund. That's really the key. You want to pick a strategy that you can stick with regardless of the market. And hey, if that happens to be American funds, I think you could do a lot worse. In my case, it happens to be index funds, and I think that's the best option for most people. All right, there you go. That is a great question. And Mark, I appreciate your question in the Facebook group. By the way, there was a great discussion back and forth from folks in response to Mark's question. So I highly recommend that you read it. If you're not a member, it's easy to become a member. Doorroller.net/Facebook group. Would love to have you join. And keep the questions coming. Again, you can shoot me an email, dr@doorroller.net. I kind of went into the weeds today a little bit. And frankly, I could have gone further. I didn't think it was necessary. Maybe I went too far into the weeds as it is. I hope all this makes sense. And I'm happy to hear your comments on it, good, bad, or otherwise. So shoot me an email, dr@doorroller.net, and I'd be happy to hear from you and perhaps share what you have to say in a future show. Hey, hope you have a great day, a great week. Until next time, remember, the best thing money can buy is financial freedom.